You have been brainwashed. The symptom, you believe that your credit score shows how responsible you are with money. But in reality, it actually shows how profitable you are to the banks. You pay off debt and barely touch the credit cards. Your score can drop, but if you keep using it everywhere, it will rise. And if you can't get approved, you fall into the some other place underground credit card world. It is full of pawn shops, payday loans, title lenders, where interest can hit over 1000% a year. So I am Author Syed, your personal finance expert, and in this video, I will show you the hidden system that trap you in debt and completely mess your personal finances. Why credit score are not what they seem. Look, 80% adults in America have a credit score. This score is a number between 300 and 850. Banks use it to decide if you are fit to get a loan, where you live, and even if you get a job. A high score should means you are safe with money, but the system is rigged. Pay off a loan and your score might drop. Instead, stack up cards, pay off one loan and take another. Your score rises. Just one condition there is, you can never miss a payment. And these credit scores are comparatively new. The first FICO score appeared in 1989. But why? For that, you have to look at the 1970s. It was the time when factories closed, union jobs vanished, low-wage service work replaced them. At that same time, courts let banks charge any interest they wanted. You see, taking debt was not an option, but mandatory. It became survival. So credit cards went from losing money to massive profit. When people started carrying balances, banks called them revolvers. They made the most money from the people who never paid in full because it paid high interest and fees to banks on carried balances. Computers let banks use formulas instead of gut instincts. By the 1980s, FICO had formula, and by the 1990s, banks had the perfect customer, not the one who paid, but the one who stayed in debt forever. The system got darker. The banks pushed the bad loans, especially on black families, calling them ghetto loans. Definitely, these loans were meant to fail because struggling families meant they were charged with more fees, more interest, more profit. And even now, it is always a middle-class man who has enough money to pay off the debt, but never has enough to do something without taking loan. The result, back-to-back loans and good credit score. It is a cycle. So stop thinking credit score is a measure of how good you are with money. It measures how profitable you are to lenders. It only asks how much can we squeeze from you before you collapse. And they only exist because the economy runs on debt. You can chase the perfect score your whole life, but in the end, the system makes sure you are the one paying. Underground money lending in America. In simple terms, underground credit system means loans outside banks. People call them alternative lending, fringe lending, or just survival cash. They are expensive, risky, and designed for people who are shut out of normal credit from banks. Then who gives them loan? Pawn shops, payday loans, car title loans, rent-to-own stores, check cashing services, tax refund loans, even phone apps. This is how the system works. Pawn shops take your jewelry or electronics, hand you cash, and if you don't pay back with interest, they keep your stuff. But the real big thing is the cutthroat interest rates in it, which runs from 13 to 1,300% a year. Yes, that is right, and they have existed since colonial America. So if you borrow $100, pay $10 to $20 in fees due on your next paycheck. That is 300 to 400% annual interest. When payday loans got banned, loan shark filled the gap, charging 20% every 2 weeks. Car title loans. Hand over your car title, miss a payment, lose your car. Rates often exceeds 100%, with some states allowing 200 to 300%. Rent-to-own stores, weekly payments on furniture or electronics, often double the real cost. Effective rate is over 100% a year. For tax refund loans, you need to get your refund early, but fees eat it up. And then comes new paycheck, advance app. They look modern, but the math says over 100% interest. The average user takes 27 advances per year. So legal or not, these systems thrive where banks say no. They target wage earners, the unbanked, the desperate. Some are state regulated, others operate in the shadow. All of them prove one thing: if you cannot get credit, someone is waiting to sell it at a brutal price. History of predatory lending. And here, to understand this system, it is important to take a look at how it came to existence. As I said, don't think this is something new. Predatory lending runs deep in American history. In the 1800s, loan sharks and salary lenders thrived, charging 50% in month or more. By the Civil War, some demanded returns of over 500%. State tried to cap rates, usually at 6 to 12% yearly, but loopholes and weak enforcement kept alive. Hidden fees, collateral tricks, and underground lending carried on. Pawnshop became the fallback. Since colonial time, pawnbrokers offered small loans when banks shut their doors. Even with licenses and caps, rates of 1 to 25% per month were common. Though the 1900s, the underground credit stayed the last resort for the people with poor or no credit. And by mid-century, new models appeared: rent-to-own, tax refund loans, and later payday lenders. But until the 1990s, mainstream borrowing meant banks and credit cards. The French credit boom, with its modern twist, only exploded at the century's end. Modern French lending takes off. In 1980s and 90s, new players exploded on the scene. Payday and title lenders, often storefront chains, targeted low-income borrowers. The first payday shop opened in 1993. By 2007, there were about 24,000 such stores in America. Consumers lacking bank credit relied on these short-term loans repeatedly. Between 1996 and 2007, the payday industry volume ballooned. Even interest payday loans grew rapidly. During this time, French credit was largely unregulated at the federal level. State government created a patchwork of different laws. Some states, like Georgia and North Carolina, banned payday loans completely. Others, like Utah and Idaho, allowed them with few limits. By the late 2000s, industry growth largely stopped as numerous states tightened rules. Many states also forbade or capped title loans. 26 states banned them outright. 12 states imposed caps of 21 to 304% per year. Pawnshop faced interest caps in 40 states. Despite these laws, lenders found ways around them. Because tribal sovereignty gave payday lenders a new loophole. Some Native American tribes ran online payday loan sites, paying state laws did not apply to them. This let them give loans all over the country without limits. Some other tricks came into the sea too. Lead sites collected borrower details, and the rent-a-bank deal helped lender hide behind banks. These made payday lending harder to track. By the late 2000s, payday loans were under fire. Critics said they trapped people in debt. Borrowers often took many loans in a year, paid huge fees, and stayed stuck. And now the government stepped in. In the mid-2000s, Congress banned payday loans for soldiers under the Military Lending Act. Cities like Oakland and San Francisco limited the number of payday shops. In 2010, the Consumer Financial Protection Bureau was set up and began strict action. But still, by then payday lenders were common in poor areas, filling the gap left by banks. Digital disruption changes everything. And then came the digital era. The 2010 and 2020 changed credit in big ways. Online lenders took over. With one click, people could borrow money, often not knowing the site was not licensed in their state. By 2013, California warned that payday lenders online were breaking the rules. Many hid their offshore or behind fake sites. They raided bank accounts, charged huge rates, and were hard to stop. California even had to chase lenders in Costa Rica and Malta. Meanwhile, fintech apps added to the mess. Those earned wage apps said workers could get paid early for a small fee. But these were really loans with an annual percentage rate of 100%. By 2022, even million Americans took $22 billion in wage advance, averaging 27 times a year. That meant high cost, similar to payday loan, with rates nearly 109%. On the other hand, buy now, pay later service like Klarna and Affirm offered easy plans, sometimes interest-free. But critics warned they pulled people into hidden debt while avoiding rules. By the 2020, underground credits moved online. Social media ads, pre-approved payday offers, and aggressive targeting were common. Just like now, every now and then you get SMS saying you have a pre-approved loan from any random app. For that reason, in 2024, lawmaker passed the Safe Lending Act. It targeted fake lead generator sites, forced lenders to follow strict state rules, and let consumer cancel unauthorized bank withdrawal. Why underground credit is hard to stop? This underground credit world runs on weak rules. Banks are watched by the federal government, but fringe lenders hide in loopholes. Each state has its own rules for payday loans, pawn shops, and rent-to-own deeds. There is no national cap on interest, no single license system. Lenders use these cracks to grow. Tribal lending is a big blind spot. Tribes say state loan laws don't apply to them. Lender joins hands with tribes to sell costly loans everywhere. Borrowers can't easily sue. Online lenders do the same with offshore firms. They break rules, vanish fast, and steal customer data. Enforcement is weak. State lawyers have little money and face long court fights. Federal checks are rare. Courts take years to rule. In the meantime, borrowers suffers. Lenders pull money without consent. They create fake checks. They keep charging non-stop. Fees pile up. Processing charges, rollovers, and prepaid cards with hidden cost. Lead seller trade person info. Borrowers end up with fake debt they can't track. Regulators move slow. Lenders move fast. They go online, team up with tribes or banks, or just rename products. The truth is, banks don't end the system. They only push it deeper underground. In poor areas, payday loan drain money from the community. The fee go to faraway lenders instead of local shops or banks. When people depend on these costly loans, they cannot save or build good credit. This keeps families stuck on the edge of financial system. Underground credit card fraud. The reason is simple. These are the very people least able to afford it. The industry thrives on borrowers with poor credit or no savings who need emergency cash. The cycle is brutal. Borrowers roll over loans to pay old fees, sinking deeper. Bounce check, debt collectors, and financial distress all fuel payday use. Where payday lending is banned, loan sharks step in, waiting outside check cashing stores, charging even worse rates, like an annualized rate around 300%. For household with no saving, that eats 1/3 of the income. So if you are watching this video and understand what I meant to say, always try to stay away from getting into these kind of loans and massive interest rates, because there is no turning back once you get in. And the result, the middle class gets lower, middle class, and sometimes even poorer. But I know many of you have already taken some kind of loan, either from banks or from underground lenders. And now you are trapped in a dangerous cycle where your hard-earned money is continuously drained out. Plus, you have no idea how to get out of this. But in my next video, I will help you, showing you the way to pay off all your loans and start your finance journey towards investments.